Well, James Clarke of Blue Owl, the Senior Managing Director and Global Head of Institutional Capital, welcome to Capital Decanted.
Thanks, John. Pleasure to be here. Keen follower, long-time listener.
Well, you're very kind, even though if you lie well, but we're grateful to have you on board. I feel like this is long overdue. We have a lot of close shared friends, so good to finally be able to spend some time with you on a topic that actually you have taught me about in some of your previous interviews. So we'll get to that in a bit, but I'm keen to kind of pick your brain on total portfolio approach. So I'd like to start a little bit with kind of your journey on this. We have spent a lot of time at Kaya talking about our journey and asset owners' journey on this, but I'd love for you to tell us a little bit about when was the first time TPA or even different vernacular that eventually grew into TPA, kind of crossed your radar, and how are those conversations with LPs and other GPs developed since that time?
Yeah, look, by hook or by crook, I've been at this for 30 years. I started off pretty much in the long-only world, in long-only equity and fixed income. And you know what's really interesting when you actually take a step back to look at asset allocations? When I first started doing this, it was all around the 60-40 model, 60% equities, 40% bonds. Um, and then pretty much on the very early stages of my career, you had the tech wreck of April 14, 2000, I believe it was. And equity markets over 2000, 2001, and 2002, the S&P was negative the entire time. So all of a sudden, you had these very large institutional investors that were shackled to very poor returns from 60% of their portfolio. And so the nomenclature of alternatives started to make its way in. I mean, this is an astounding fact. If you actually looked at the S&P 500 over the last 100 years, the annualized return is 10%. If you asked how many times in a calendar year did it fall between 8 and 12%, you'd be shocked. I'm not going to put you on the spot here. It's 6. So that shows the volatility of it. And what they were looking for was a more consistent way to hit their actual rates of return. Obviously, the funding ratios had been crippled by these. You'd had some spectacular corporate scandals and failures, predominantly Enron and WorldCom. So it moved to alternatives. And I think that the TPA discussion started to make its way when you saw all these sovereign wealth funds of significant scale start to pop up in the mid part of the 2000s. There was obviously the Australia's Future Fund, and there was a number of other Middle Eastern institutions and so on and so forth that grew up. And I think that what happened was everybody just felt like a little bit constrained around strategic asset allocation. They felt that they had to operate within these bands, and you have a situation where you have what's called the denominator effect right now, which is where equities sell off. And now all of a sudden, through no rebalancing, you're over allocated to private markets, and you can't put any more capital to work until you rebalance in the public equity space. So the TPA approach has been really sort of to demystify asset class buckets and think about things more holistically at the total portfolio level. And that seems to be gathering momentum. And in fact, this week, there was a lot of press around the California Public Employees Retirement System, who's coincidentally their CIO, Steve Gilmore, came from New Zealand's superannuation fund, where he basically doubled assets in a very short space of time. And I would say in large part to using this model.
So James, that's very helpful. So you kind of picked up on some of these crucible moments where LPs were starting to say, is this really the right approach for right now? And then, of course, things stabilize and you kind of forget. This is human nature, right? But they've been searching at times for this different mousetrap to avoid some of these shackles or constraints. Those are my words, not yours. Why is there this fever pitch? I mean, Kaya's feeling it simply because we've done a lot of research work on it. Why is this fever pitch on the LP side of all flavors, sizes, by the way, around the world? And yet it seems to me very few GPs are talking about it. If this is truly going to kind of take shape, there's going to be massive implications for the whole ecosystem. And yet GPs don't seem to be on top of this.
Yeah, I think it's a really good observation. I think GPs aren't on top of it because GPs don't want to be on top of it. They like the old model. The model is, hey, you have a subsect of asset allocations. Like if you look at CalPERS, essentially what they're doing is taking 11 different asset classes and collapsing them all into one total portfolio approach. But GPs like the narrative of, hey, we have this asset allocation, we've got to go and fill it. And oh, by the way, we happen to be one of those managers that you can work with and fill in it. Very few GPs ever take the time to acknowledge what their commitment does to the total portfolio. So I'll give you an example. We win $1 billion mandate, or we're awarded $1 billion mandate. That is a phenomenal achievement for us, and we're not dismissing that. But very few GPs in $1 billion mandate and a $300 billion plan don't pay attention to the other 299 billion. Now, if you think about it in your own investments, how many times do you think about thinking about a 30 basis point consideration? Not a lot, right? I know I don't. Maybe I should do it more. But the manager, one of the things we always ask when we go in for the first times is what is our role and how do we complement the rest of the program? The TPA approach, the total portfolio approach, is what does the entire organism do, not what does the arm or the leg or the nose do? It's what does the entire body of work represent and what is my role in doing that? And I've talked about this a little bit, but I think the alternative industry is undergoing a huge amount of having to grow up right now. I think in the past, you had a period of low interest rates, people were under allocated to alternatives, and managers got in this very comfortable situation where it was easy to generate strong returns because money was free essentially. And there was a demand, a very strong demand for their product to fill these allocation buckets. So the narrative was we're in market with a fund. Thank you for the money. We'll see you when we're in market with the next one. And the work that had to go into that, the client engagement was very much in the hands of the manager. We'd have to do as little work as possible, and we get to consistently get these allocations. Oh, what? We raised a $2 billion fund. The next one's 4, the next one's 8, the next one's 10. Well, things have changed. That 40-mile-an-hour tailwind is now in everybody's face. And I was speaking with a CIO the other day, and he said, these managers are almost showing up like people coming off a sugar high. Like, what do you mean I'm not getting as much money as I got in the past? What do you mean you don't have capacity to put capital into my fund? Things like that. And I think that the total portfolio approach model is going to have to reshape how people like us think about how they engage the client, right? And they're going to have to spend a lot more time understanding the broader portfolio than they are understanding just the silo of which they're in, not to mention just understanding themselves. So there are many considerations that need to go into that dialogue. And if that dialogue doesn't change, they're going to get lost in the shuffle. Thankfully, myself and many of us come from the public world, as I explained to you in the past, where at any single moment, a client could call you up because your assets were held publicly and say, for whatever reason, we're pulling the mandate. And that could be gone within a day, $1 billion account. Sell it out there in the market. They use the capital, they use the proceeds and go somewhere else. So you were attuned to making sure that you were in front of the clients 24/7. But when you have private market portfolios, closed end funds, that's not a concern because you say, oh, we'll deliver your return over, investment periods, 3 years, 4-year extension, blah, blah, blah. And we'll come and see you later on. The threat of redemption isn't there, but that's changed. And if you're not in a partnership with the client, I think you're going to get found out. And so GPs do need to get alive to this now.
So I want to press you a bit more on this mindset shift, this partnership model, and actually, I think I shared this with you. I was on a run, I think, in Europe, and you stopped me in my tracks with a quote you had on our buddy Ted Seide's podcast, your second favorite podcast, Capital Allocators.
Right.
So I'm going to
Well,
quote you
it's
back.
good. I like rewatchables by,
Okay, there you go. We
yeah,
love Ted. We love Ted.
yeah.
But I'm going to quote you to yourself, and then I want you to tell me more about this. But you said, quote, the moment you put a firm's interest ahead of of the client, you're done. Portfolio fit is much more important than how great a strategy claims to be. When you're following a TPA approach, the strategy decision might be the third derivative from choice after funding ratio, actual rate of return target. What does the portfolio look like? You need to be in active listening mode to truly understand the investment zeitgeist. That was impressive, James. Zeitgeist of the organization. Tell me what you meant by
I need
that.
to understand what's the definition of zeitgeist?
Whoever said that's a smart dude.
Yeah. Well, look, that quote is the most important thing. I mean, we always say around here. In fact, it was my CEO Doug Ostrover who said he always says to the clients, "What's important to you is important to us." And I think a lot of managers dismiss certain things as, well, that's not important. I don't really care what they think. This is what I think. It's not what you think. When I talk to our team here, and we have 130 people, and we cover the entire world, we're essentially dealing with about 4,000 different situations. Each client is very different. What their asset allocation is, how their board decisions are made, who their asset consultant is, who are their members, what is the age of those members. There's an Australian superannuation fund set up for hospitality workers. I was a member of it. I used to be a waiter, right? Back in the day, in the early 90s when superannuation first kicked in. And I used to get this paycheck, and it wasn't a lot. And it would say 8% has gone to this fund. And I'd be 19 and I can't touch this money till I'm 65. That's ridiculous. But the makeup of that organization means that it can do very different things because it's got a younger membership. So we always say here, we don't sell product, we position partnerships. And I'll be honest with you, there are times where I've been to certain organizations and they've told me their list of credit managers or how they think about real estate. And I've said to them, you know what? We're not a fit right now. We don't fit in. There will be a time, and maybe one of these managers will underperform, or maybe you'll get sick of them. But the most important thing I find in any first meeting or any first engagement is trying to understand what they are trying to achieve. And if you boil it down into the true essence of what it is, it's how do you help me solve a problem, and how do you make me look good doing that? You don't find that out if you show up, and thankfully I don't have a pitch book here in front of me about Blue Owl products, and I'm not about to sit here and bring it out because we don't sell products, we position partnerships. But this is actually, well, multi-strategy credit partnership for a client, right? It's got nothing to do with a fund. But if I sat there and put this on the table and just walked through it for 45 minutes straight, or an hour, and didn't ask one question, I'm never going to learn anything. And so this actual conversation is a response to about 20 different meetings. I need to blank out their name, but it's about 20 different meetings that we've had with them to get to the point where we're like, we know where you're going and we have something here that could fit. But when managers start to think about, and I've said this before, we're a public company. We trade on the stock exchange. I don't care about the share price. It doesn't matter to me. What matters to me at the end of the day is doing the right thing by the client. And if we're doing all the right things, if we're in the process, that is going to take care of itself. That we will win in the long term, and I have every reason to think we are. I see it here. I'm in it every day. We've had a phenomenal year across the board in our investments and in the assets that we've been fortunate to attain. But if you go into these meetings with, I need something at the end of this, and damn the torpedoes, it's going to happen, hell or high water, I'm going to get it, you miss everything. And again, we're dealing with very, very different audiences in different regions. And within those regions, a teacher's plan is very different than a foundation and endowment. It's very different than a healthcare plan. Defined contribution, defined benefit, TPA, SAA model. If all you're doing is going in there with 50 cents in the jukebox and hitting play and singing Summer of '69, and they don't like Bryan Adams, I mean, who does? But although that was a good song, I'll give you that. But if then you're not playing to the audience, and the audience changes every night.
Well, you offend one of Canada's best, and you're in trouble there with
I do
Brian.
like that song. I
Yeah.
will.
Okay. Okay.
Although it was better when
eh,
the Foo Fighters sung it, I will say. If you ever find that on YouTube, it's not a bad version.
cover. I think this whole pathway from beauty contests to fill a gap in the portfolio, right, where you're just competing against other asset class strategies of whatever 2 or 3% happens to be open in the portfolio, to long-term solutions provider where you're listening and trying to help them solve problems, holding their hand, figuratively speaking, is a really good segue to a definitional question I wanted to ask you, because I think because of the CalPERS news, because of this acceleration of adoption and interest in the press, I think there's a couple extremes getting this way wrong. One is, this is just an incremental evolution of the endowment model, or SAA, and frankly, there's nothing new here, nothing to see here. The other extreme is that it doesn't borrow on any of that, and it's something that's completely unrelated to LPGP alignment. And the way I've thought about this is that SAA is an investment model, and whether it's endowment or the Canadian version or maybe the US pension fund version, they're all variations of an investment model that you plug in. I think TPA is more of a fund model because it speaks to purpose of the fund. It talks much more about governance and culture. It's broader than how you pick strategies and fill up 100% of your portfolio. Do you agree with that assessment, and why or why not?
Yeah, I do. I mean, I've got, look, this is the presentation. This is the CalPERS presentation at their last board meeting. It was yesterday, November 8. Oh, sorry, this was the one this time last year, November 18, 2024. And it talks a lot about the actual considerations of how to implement this. It talks about what the role of this is doing. It is an investment framework, and it's all orientated around the actual rate of return, and saying, hey, if we peg ourselves to these asset classes, like if you look at what's happened since 2020, you had the pandemic, interest rates have gone up, there's been a lot more volatility in the markets. That volatility in public equity space has purely been predicated on 7 stocks, right? The only free lunch that any institution can get is diversification. And when you're looking at the S&P last year and you're saying, oh man, we nailed it, it was up 23%. Well, if you took out the S&P Mag 7, it was only up 9%. So the opportunity to be more nimble, the opportunity to say, hey, there are other areas there on a risk adjusted basis. It looks from here that the risk budget that they're taking across the entire portfolio is about 400 basis points. They're continually adapting and being thoughtful about what are the other areas in the market that we can tap into. And look, it's not going to be embraced by everybody, right? That I think that's one thing that needs to be understood. Many of these defined benefit plans in the United States have been around, since the ERISA Act of 1974, right? Since Richard Nixon was president, been around a long time. To suddenly flip the processes in the right way for all of them, but really the framework here is understanding the portfolio at the highest level of what is the objective, and that asset classes aren't necessarily struggling against each other for attention, devoid of what the ultimate return objective is of the organization. So yes, it is an investment platform.
Yeah. So James, let's get a bit crunchier, circling back to kind of the why aren't GPs paying more attention? Why aren't they adapting a bit more? Do they really grasp this? Do they like it? If you're giving advice, I mean, first of all, looking inward at Blue Owl, how are you thinking about adopting or adapting or evolving to meet this changing need? I think it's in your DNA as you described, but I suspect there's even more evolution that needs to be done in the way you engage with prospective and current LPs. But what advice would you give to those that are just kind of trying to understand, GPs that is, understand this move to TPA when it comes to alignment of interest and products and service model?
Yeah, look, you raised a really good point. You said it's ingrained in our DNA. I mean, one thing I want to say is we don't have all the right answers and we're continually learning. And I'll give you an interesting anecdote and I'll get to your question. Last week, I put out these white papers called From the Front Line, and they've got a bit of a following. And I talked about, I used the word deployment, right? I said deploying capital. And a CEO, a very well regarded one from one of the big Australian superannuation funds, wrote me and said, I love the piece. Going forward, don't use the word deploy. It sounds like asset gathering. Use the word invest. It's smarter. So you are always learning. And I took that note and I sent it around the firm to everybody who is in front of clients, all the way up to the CEOs, and said, this is great feedback. This is important. Now, maybe there's a bunch of other firms out there that say, we've never used the word deploy in our lives. What is Blue Owl thinking by using that word? I don't know. I haven't seen it. I've heard it a lot at conferences, but you are always learning. And I think for any organization, a new GP that's coming to market, I think that, or is trying to evolve itself into a new model with its clients, the first thing is make sure you recognize that every single one of them is different. Two, make sure you understand the investment zeitgeist, how decisions are made, what's the dynamic between the CIO and the board, how much authority does the board have on investments. The CalPERS ALM study and the move towards TPA is very much giving staff the discretion, which is a good thing because they live and breathe this 24/7. But it's making sure that when you go into these meetings, it's like, I want this. No, it's not what you want. It's what can you deliver? And if you come at it from the mindset and you're not talking the whole time and you're truly understanding where they're trying to go, and also having the humility to sometimes say that doesn't work for us. Or sorry, our strategy doesn't fit right now. Would love to come back in 6 months, 12 months and see where you're at. But in my life, and I've done this, and maybe I'm probably the worst fundraising person in the history of the business. But if I look on any time we've brought a client on, it's always been somewhere between 24 to 36 months. Like the good one, like the biggest opportunities. Occasionally, you can use the word I get lucky, but really, if you want to build a partnership, like anything, a marriage, a friendship, or whatever, what's the one quotient that is the most important thing? It's time. And time doesn't happen over a 60-minute meeting. And so if you are doing this, the willingness to realize, like, I'm going to have probably 7 or 8 engagements before anything of interest is really going to materialize. And not many people have the patience for that. They don't. They want it to happen right now. But when you have a big team like we do, when you have the opportunity to canvas a lot of people, you don't have to be relying on 1 or 2 things to hopefully work out. You get to build those partnerships over a long period of time. And some of my best relationships that I go back with to when I was a kid in Australia and first started out in the business, they haven't invested with us, and maybe they never will. But the good news is every time I call them, they're willing to talk to me. They won't talk to me if every time I call them, I'm going to ask for something.
It's funny, your example with deploy, just is a good reminder that yes, behavior needs to change, but even our language matters. What you say reflects who you are and how you act. And so I think that's a really good reminder. I hadn't thought through that. So I appreciate that. Maybe just to press you.
I don't like the word LP and GP. I actually hate them too. That to me sounds like a contract, right? That's an investment agreement.
Hmm.
To me, it's partner manager, partner client.
Okay. Well, there you go. Yeah, I think there's a lot of rewiring we need to do from language down through how we act. Let me just press you on a couple more of those kind of behaviors or adjustments. Um, so benchmarking, SAA is built on this kind of slavery to benchmarking at asset classes, at multi-asset classes. You got three or four at the portfolio level, and you're just bound by these bogeys that you're constantly facing. And this idea of constructing a portfolio that meets the funding purpose of the corpus is a very different dynamic. So that's one. And then the other one is an issue of scaling. So in the old days, in SAA world, Blue Owl has a new direct lending fund or a new middle market buyout fund. You can scale that really easily. You shop it around and who wants to plug in, and you scale it really well. And what you're talking about in this partnership and active listening and solutions business, by its very nature, is more custom, tailored, bespoke. So maybe talk a little bit about scalability in the new world and benchmarking.
There was an interesting article that came out in the Financial Times a couple of weeks ago. It was from a private equity manager, was quoted in it, and that there are 15,000 private market funds out there and only 5,000 raised capital. Right, this year, fundraising in private markets, in the ones that we focus on, are down 20%. I'm happy to report we're up a considerable amount. But again, those are conversations that, by the way, started taking place in 2019, 2020, 2021. I think that the structure of how people access alternatives is changing rapidly. You now have the adoption of evergreen strategies. People want to maintain their asset allocation to a certain asset class. Certain asset classes like direct lending, where we have a very big platform, have morphed from being a tactical asset allocation, meaning short term, we get a dislocation in spreads, we come into the fund, they contract, we made money, and maybe the client's like, that's it, that opportunity is over and gone. But over time, it's proven itself as a sustainable investment and has now morphed into being a strategic asset allocation for the long term. What that has meant, though, is that the client can't be beholden to when you're in market or out of market, because if they're trying to maintain that exposure and you don't happen to be around, or the other great managers that they've selected, because they're not just going to do you, are not around, they're going to start allocating to people that are second and third tier, and all of a sudden they're going to have 30 line items. The one thing that I hear is that we are trying to rationalize the number of relationships, bigger line items with fewer partners. Okay, and that means bringing solutions to people that are in SMA form, fund of one form, evergreen structures, where they can have the ability to increase that allocation, and maybe down the road, if they're dissatisfied or they feel like they need to push money to another area of the market, they can sell out of those, get an off ramp, and deploy that capital differently. But it has changed the dynamic a lot. And I think with the other thing is that a manager has to bring, you can't be a jack of all trades, a master of none. But where we specialize at Blue Owl is in areas where the demand of capital out there by the private market community is really high, and the number of managers that have the ability to speak to it is very, very low. And those are areas where we prosecute it, whether it's GP stakes, whether it's direct lending, whether it's triple net lease real estate, and now into the data center space. And that's where we are. That's where we gravitate and where we orientate ourselves. But a manager wants to be able to bring those things to a client, and a client wants to say, I know that they do those things really well. I know that I can do a number of those things really well with them. Oh, and by the way, I don't have the time to take 15,000 phone calls a year. Even if you did that, you actually wouldn't have the time. So I think that the industry is scaling to the bigger players, and I think scale begets scale. And I think the bigger allocators are wanting to be around into those ecosystems where they can get preferential terms, they can get preferential structures, and they can have a say in how that mandate is customized, bespoke for them.
So I want to end with one final question. I think you've touched on bits and pieces of this, but I'm going to give you a chance to have another zeitgeist mic drop moment here, James. But let's just say, you go to sleep in a cryo chamber for 5 years, and you wake up, and you can't choose Blue Owl. But just imagine yourself: you wake up in a GP that has done a particularly good job of adapting to TPA. What is kind of the biggest change in their operational activity that you would notice?
Well, I'm clutching for a thesaurus here to hopefully come up with another word that may you may gravitate to, but I haven't. I've left it at home. Um, Look, I think it's really three things. I think it's scale, customization, and transparency. If you actually, and by transparency, I mean a number of different things. A quote that was given to me recently is good news is bad news told early. And I think it's incumbent on all of us to make sure that, look, we work in investments. Investments aren't always going to work out. We need to make sure that we're constantly availing to our clients exactly what's going on in their portfolios. But I do think that the scale is important. You can only customize if you have scale. A new manager coming out to market right now, and I've said this before, and I know that people here don't like it, but if Al Rock, which was the precursor to Blue Owl direct lending platform, had come to market today, there would be no reason for us to exist. I mean, I couldn't think of anything more difficult than going out there right now and saying, hey, we're looking to raise a $5 billion first time fund. If you are big and you're fortunate to be big, then you can bring in all these other attributes, right? You can bring in the great client service. A lot of people spend way too much time talking about the money they don't have rather than the money they have. It is so important that when you are fortunate to work with these institutional clients, that you treat them just the way, if not better than you treated them when they didn't have money with you. So scale allows you to do that. Scale allows you to avail the portfolio and investment teams to them on a more frequent basis because you have larger teams. Customization, critical. Again, we're dealing with 4,000 different situations. And what works for somebody, someone may come to you and say, hey, we love the data center trade. We're not ginned up on North America. Is there something you could do for us in Asia Pac? Right? And we've done deals in Asia Pac in our data center business. And so you want to be able to bring those things, and at least you want to be able to have that dialogue. And you can't do that if you're one dimensional. You just can't. And the last thing, as I said, is transparency. It's communication, addressing concerns quickly. I always say when you have a challenging time, we've had a bit of a challenging week this week. It's the important thing is not to go quiet. The important thing is to actually turn the volume up.
Well, I think those are very wise words, James. You've got a fresh and fun way of capturing all of this. I'm so glad that you joined us on Capital Decanted. Thanks so much for being here. That was some really helpful guidance, particularly on the GP evolution.
My pleasure, John, and I appreciate everything you're doing for Kaya, and it seems to be an organization that continues to blossom and grow. So congratulations.
I appreciate that. We're working hard. So thanks, James, for joining. And Capital Decanters, thanks as always for joining this episode.